So I heard that the inventor of the 4% rule just changed his own rule. Hello everyone and welcome to mangomonkey Learns Money. So there are actually two types of the 4% rule of investment. The first one is the rule that says you assume your investment portfolio gives you a rate of return of 4% per annum. So if you have $1 million and you can live comfortably on $40,000 a year, you can basically retire and never run out of money ever. That is also assuming that you do not need to pay taxes. And the second, which is the correct 4% rule, is actually a rule that says if you are already retired and you want to know how much you can withdraw from your retirement account, in other words, from your pension account or your superannuation account, the amount that you can withdraw is 4% of the balance of your retirement account. This rule was formulated by a guy called Bill Bengen more than 25 years ago. If you withdraw 4% per annum, it is likely that you will still have $1 in your retirement account at the end of 30 years after you retire. So the real 4% rule is saying you will run out of money in 30 years, but because you are probably already 60 years old when you retire, you may not even be alive anyway when you have run out of money. In some of my earlier videos, I have been using the wrong definition of the 4% rule, and I apologize for my oversight. So in October this year, the inventor of the 4% rule actually changed his rule. Bill Bengen says that based on the current environment, he thinks a new retiree should be safe if they start with a withdrawal rate of no more than 5%. The average safe withdrawal rate is actually 7%. That is, if you retire and withdraw 7% of your retirement or superannuation account each year, you will still have a little bit of money left over after 30 years in retirement. The reason he relaxed his rule recently is because we are in a low inflation environment. It was actually inflation more than the bear markets in stocks and bonds that really crushed retirees in the 1970s. And inflation is worse for retirees compared to the bear markets, because bear markets eventually end and stocks and bonds recover. Higher prices, once they have arrived, never go back to where they were before. So when you get inflation, it gets locked in. You are stuck with the higher prices for 30 years. By the way, this rule assumes you invest 30% of your money in the S&P 500 index in the United States, 20% in United States small companies, and 50% in intermediate US Treasury bonds. This sort of combination should allow you to reasonably withdraw 4% a year, even when the stock market goes into a bear market. Because generally speaking, you do not want to sell out of your stock portfolio when the market is at the bottom, because that will essentially lock in your losses, and your potential upside is not certain. Did you find this video interesting or useful? If so, please consider hitting the like button and sharing it with a friend or two. I make daily videos on investing and personal finance. Please also feel free to subscribe to my channel.